Hi everyone, welcome back to Economics per se. We're at topic number 3 of the first chapter now. We're going to be looking at measuring the economy today. Mostly we'll be talking about GDP and unemployment. Let's start off. So years ago, we had to rely on what we saw day to day to figure out what was going on in the economy. But experiences may differ from person to person, which may lead to conflicting theories. Because of this, we needed a way to combine the various experiences of many people and find a way to compare or measure them. This is where data comes in. Today, we have data on many different things from a lot of reliable sources. Statistics Canada actually conducts many surveys to collect data on many things, ranging from unemployment rates to even levels of education. These data help us summarize the condition of the economy, which is crucial for policymakers to formulate policies. Now, in this video, we are going to focus on two very important statistics which are vital for the economy: the GDP and the unemployment rate. Alright, so first, the gross domestic product. GDP is defined as the sum total in monetary value of all goods and services produced in an economy at a period of time. But we can also look at GDP as the total income of everyone in the economy, or as the total expenditure on the economy's output of goods and services. It should be clear from the definition that GDP is mostly considered the best way to measure how well the economy is performing, because it measures a thing we all deeply care about, our income. But now you may think, how could GDP measure both the income and the expenditure on output? It's because the economy considers income and expenditure as the same. Since every transaction has a buyer and a seller, every dollar spent by a buyer is an income for the seller. National income accounting, the accounting system to measure GDP, is really helpful here. This idea can be explained by a circular flow diagram of an economy with one product, say clothes, and one input, say labor. So we have the household here, and we have the firm. The household sells labor to the firm, and the firm sells the product, clothes, to the households. The households spend money, expenditure, to buy the clothes, and the firm pays the households their income as compensation for their work. GDP should therefore be calculated as either one of the two, either as expense or income, not both, but they will be equal. Okay, so now let's discuss the rules of computing GDP. Firstly, the economy produces many different goods. In our diagram before, we looked at an economy producing clothes, but the prices of shirts and pants are different. Say we produced 6 shirts and 3 pants, and we could simply add them and say the GDP equals 9 garments. However, this would only work if we considered pants and shirts to be the same, which I hope you don't think is true. To reflect the different prices of different items, national accounts uses market prices to show how much people are willing to spend on certain items. So if shirts cost $2 and pants cost $4, then the GDP would be calculated as the price of shirts times the quantity of shirts plus the price of pants times the quantity of pants, which would give you 24. The second rule is concerning used goods. What if you sold your old shirt to a cousin? Would that be part of the GDP? No, it wouldn't, because the value of that shirt was already added to the GDP when it was first sold to you. The third one is, what if producers are not able to sell 2 out of the 6 shirts this time when they have already paid the workers to produce it? Well, now there are 2 scenarios here. First, if the shirts are never sold and go to waste, the firm has lost profit because he has had to pay the workers but hasn't sold the product. Total expenditure doesn't change because no one buys the shirts. Total income hasn't changed either, but more had been distributed as wages and less as profits now. The second scenario is when the firm decides to sell the unsold shirts at a different time. In this situation, the firm is assumed to have bought his own product and the amount is added to the GDP. When the firm later on sells the shirts, it's just considered similar to the used goods scenario that we discussed earlier. The fourth one is concerning intermediate goods. Intermediate goods and value added are almost the same. A lot of materials are used in the production of shirts, like pieces of cloth and maybe even buttons, but the particular values of those materials are not calculated separately in the GDP. Only the value of the final good is added to the GDP. This is because the values of the intermediate goods are already added as a part of the price of the final good, our shirt. To add the value of the intermediate goods would lead to double counting. The fifth one is regarding imputations. There are some goods and services that do not trade hands in the marketplace, and we use imputations for them. The services of, let's say, government officials are not sold in the marketplace, so they are given a value for their services based on their wages. The national accounts add these services to the GDP based on their wages. Another example is of home ownership. If you rent an apartment, then your rent is added to the GDP. But what if you own a house? The national accounts calculate rents that homeowners pay themselves and add these to the GDP. But in practice, these imputations do not necessarily happen, because if they did, what about the imputations for rent you pay to use your own car, or the value of the food you cook at home? Both you and the restaurants cook, right? But do you sell yourself the meals you cook? These don't get added to the GDP. And now lastly, concerning the informal markets. No transactions made in the informal market or the underground sector can be added to the GDP. There are no records for them. So now that we know what GDP is, let's look at nominal and real GDP. Nominal GDP is what we calculated with shirts and pants earlier. It uses market prices to measure the value of goods and services. Nominal GDP, however, is not the best way to gauge how well an economy is doing. If the prices doubled, the GDP would double, but this doesn't mean that the economy's ability to produce has doubled, because the quantity hasn't changed. A better way to measure economic well-being is by using real GDP. Real GDP measures the value of goods and services using a constant set of prices. In other words, it shows what would have happened if quantity hadn't changed and quantity had changed and prices hadn't changed. Here, real GDP, the first one is calculated using the 2020 dollars prices multiplied by the 2020 quantity. In 2021, the real GDP would still use the price from 2020, but the quantity would be from 2021. In 2022, the price would still be from 2020 and the quantity would be from 2022. Here, the year 2020 is acting as the base year, and 2020 prices act as what is known as the base year prices. When we have the nominal and the real GDP, we can calculate something called the GDP deflator, which will show us what is happening to the overall price level in the economy. The GDP deflator is basically the ratio of the nominal GDP to the real GDP, and we can get various information from this. In this form, we can measure the price of output relative to the price in the base year. Nominal GDP can also be obtained from this, which would be real GDP times the GDP deflator. In this form, we can see the current value of the output of the economy. And then real GDP here would be nominal GDP over the GDP deflator. And here we can see where the GDP deflator gets its name. It literally takes inflation out of the nominal GDP. Let's now look at the four broad components of GDP. GDP is equal to consumption, investment, government expenses, and net exports. This equation is an identity, so it must hold based on the way the variables are defined. Every dollar in the GDP must fall in one of the four components. It's also called the national income accounts identity. The consumption, C, includes all goods and services bought by the households. It's subcategorized into durable goods, non-durable goods, and services. I, the investment, can be thought of as goods bought for future use. It also has three components, like the business fixed investments, which includes purchases of new plants and equipments. Then there's the residential fixed investments, which consist of purchases of a new home. And then there are inventory investments. G, which stands for government purchases, includes all goods and services bought and sold by the government, like construction of new roads, investment in the military, or funding for coronavirus research. However, transfer payments like welfare payments are not a part of the GDP because that is just the reallocation of existing funds and not in exchange of goods and services. Now, lastly, NX, net exports, is the difference between exports and imports. So, we've talked a lot about GDP now, but GDP is not the only measure of income. There is the gross national income, also the GNP, which measures total income earned by all nationals. If you owned a business in the US, the value produced by your business would be added to the US GDP, but it will not be a part of the US GNP if you're not a citizen of the US. GNP is just equal to the GDP plus factor payments from abroad minus factor payments to abroad. There is something called the net national product as well. The net national product is equal to the GNP minus depreciation. National capital will depreciate and the net national product just adjusts GNP for depreciation. Now turning our attention to unemployment. The major statistics department of a country will conduct monthly surveys to get employment and unemployment figures. In Canada, the Labour Force Survey does this and publishes monthly data on these important figures. You can either be considered employed, unemployed, or not in the labour force. Employed includes people aged 15 and above who during the time of the survey worked as paid employees, were self-employed, or worked unpaid in a family business. It also includes people who are temporarily not at work. Unemployed includes people 15 and above who were not employed, were available for work, and sought employment during the past 4 weeks. Now, not in the labor force includes full-time students, husbands or wives, or retirees. These don't fit into both employed and unemployed categories. A person who wants a job but has given up looking for a job in the past 4 weeks before the survey is also considered not in the labor force. The labor force is defined as the sum total of the employed and the unemployed in the economy. The unemployment rate is the proportion of the labor force, not the population that is unemployed. Another important statistic related to these is the labor force participation rate, which is the proportion of the labor force in the civilian non-institutionalized population. The civilian non-institutionalized population refers to everyone above the age of 15, not in the armed forces and not institutionalized, meaning not in prisons. In Canada today, the labor force comprises of about 18,600,000 people. The unemployment rate today, May of 2020, is about 13%. Last April, it was 5.7% and it was 7.8% just a month ago. This increase can be attributed to the current COVID-19 pandemic. Now that we have a deeper understanding of the science and the data involved in macroeconomics, in the next chapter, we will learn the classical theory to look at the economy in the long run. I hope to see you then. If you like the videos, please give us a like, subscribe, share, and see you next time.